Hello, real estate mindset community. Good morning and happy Friday. Thank you for joining me today for our morning live and update video. And also, I just wanted you guys to know, look at my shirt right here. Boom, got the hey, you guys. Obviously, I'm trying to get better at presenting information. I hate saying you guys. So what I'm going to do today is we're going to go over a market update, some big moves in the market with PCE that came out. And then I'm going to do something different today. After the market update, I'm going to do and I have to be so careful here because I'm going to do basically a reaction video to both Dave Ramsey and also Brian from Clear Tax. Now, if you're watching this, I just want to reassure you that when I do the reaction, I'm going to be completely respectful. There's going to be no bashing. I don't want to offend anyone that's watching this video. I don't want to be selfish. I want to be completely humble because I believe that, listening to Dave and listening to Brian, even though I don't agree with a lot of what they're saying, it allows me to be sharper. It allows me to ask, why are they saying this? And what can I provide the viewers to counter what they're saying? And guys, I'm not gonna lie to you. I mean, I woke up at like 1:30 a.m. this morning. And I'm thinking about, okay, inventory, where do we get the inventory? How did just over and over and over, I'm just constantly beating myself up to make sure that my opinion is right, to make sure that I stay sharp, okay? And just wanna let you guys know that. I see you right. Thank you so much, Tommy, for joining. I see that. I'm going to get started right away, you guys, on our market update. I feel a little bit off because, again, I just didn't really get that much sleep. So I apologize for that. But let's start with our market update right now. And we're going to start with PCE. Okay, so PCE came out today, excuse me, I got to slow down. I'm a little excited because it's Friday. And after this, I'm going to go play with my children and go build a fort. Literally, when this is done, I'm going to go build a fort with my children. I feel so outworked right now. But anyways, PCE. Okay, so good news, right? Good news. Inflation only goes up a little bit. Okay, so PCE went up and they're celebrating. Yeah, it raised only milder than expected. You guys, inflation isn't going down. Inflation is going up and they're celebrating it. I mean, they got it so backwards, but just to let you guys know, PCE did go up 0.1% in August. So there's still inflation. Now, they attribute this increase in PCE to gas prices or, oil and things of that nature. So inflation is still here, unfortunately. And let's see what the 10-year is doing after this news. Now, here's the 10-year. 10-year is all, I mean, if we look at the historical movements of the 10-year treasury, this is so unprecedented. The amount of people that are either buying the 10-year or selling the 10-year is just so out of control. Now, 2 days ago, we were sitting at 4.64. We're still at over 4.5. Again, really, really alarming. Now, obviously, it kind of started the morning up and then it started going down. And then let's see, market open, it started going down, market open, probably result of PCE. I'm not 100% sure. But this morning, nevertheless, it's down 6 basis points. Okay, so that is going to impact residential mortgage rates and it's going to eventually lower the mortgage rates. We'll probably see that today, depending on what happens the rest of the afternoon with the 10-year. I mean, the moves are violent. And this is a good way to actually take your money that you have saved for down payment and to get money. So I put almost all of my down payment or money that I have to invest in real estate, I put that in 1 month treasuries. And I think I yield like something close to 4.2 to 4.4. I'm sorry, 5.2 to 5.4%. Now, let me show you the inversion. Now, we've been following the re-inversion for the past few months. This is one of the primary economic indicators that is signaling us as consumers that there is a recession coming. And it also allows us to kind of figure out if we're already in recession. And really what I want to point out is the trajectory. The trajectory of re-inversion here is insane. Last time we had this type of skyrocketing was the bank bailout. So there's probably something going on that we don't know, but also the reason why this is re-inverting is because the long end of the yields are going up. So, since the past week and a half, 2 weeks, the 10-year has shot up, that 10-year treasury has shot up, the re-inversion has happened, right? So if it's possible that this continues until we're in recession. And it's also possible that we're already in recession because when we max this out, we can see that normally we reinvert, see here, and then we enter recession. I'm not sure how well you guys can see that gray line. But again, here we reinvert and then almost immediately into recession, or a few months later, reinvert, recession, reinvert, recession. But again, back in the 70s and 80s inflationary battle, and we have an inflationary battle right now that was caused by the Federal Reserve, but that inflationary battle, basically we stayed inverted and entered recession, stayed inverted and entered recession. So I just wanted you guys to know that. Let's go to the overnight rate. The overnight repo facility is staying flat. This is just so amazing to me. So on one hand, we have all of these headwinds, all of this economic turmoil, but the market now knows the rates. I mean, basically the rates aren't high enough. And there's more tightening that needs to be done, probably because they re-injected liquidity in our market this year in March, but whatever. But this is flat, guys. So to me, this is signaling that there's at least going to be one more rate hike, at least one more rate hike. And look at the 5-year break even. It also tells us they're not done. That shot back up. So this is the 5-year break even inflation rate. This is when the Fed talks about unhinged inflation expectations. This is something that they're monitoring, that 5-year break even inflation. So what will inflation be 5 years from now? The markets, it went up. Okay. It was going down, but it shot back up to 2.27%. Again, to me, this is an indication that more than likely they're going to do more tightening. They're going to stay tightening. I don't know how much more rate hikes will happen. But again, I really feel like there's going to be at least one more rate hike, even though the market hasn't really priced that in. So let's look at mortgage rates right now, see what's happening with mortgage rates. I mean, the mortgage rates are still sitting, pretty high, sitting at 7.6%. Yesterday, rates hit the highest that they've ever been in my career. And I've been doing real estate for 22 years. So yesterday was that record high. It went down 5 basis points, not a huge difference. So I'm not going to pull up an amortization schedule. I'm not going to do any of that because we covered that yesterday. So what I want to do now is let's go into the reaction videos. And what I'm going to do, we're going to start by listening to Dave Ramsey. And then after Dave Ramsey, we're going to listen to Brian from Clear Tax. And I just wanted to say, before I begin, here's what I'm going to do. So we're going to very respectfully, or I'm going to very respectfully, we're not going to listen to the whole thing. We're going to listen to bits, basically their conclusions, some of their conclusions. And I'm going to be incredibly respectful because, I'm thinking to myself, honestly, I appreciate in some ways, I have to be careful how I say this, but I appreciate in some ways that they have such a difference of opinion than me. Because someone that really cares, someone that's like really cares about what's happening in their opinion, you're going to listen to the critics, right? You're going to listen to people with differences of opinion. So I've listened to them, really difficult to do, but they basically put me down a path to where I'm going to go over where I think inventory is going to come from. So I'm going to, after we're done listening to Dave Ramsey and after we're done listening to Brian, I'm going to go over where I believe, where I believe the inventory is going to come from. And then I'm going to go over the health of the consumer and the economy. And I'm also going to compare inflation, unaffordability, PE ratio, equity run-up, things like that. I'm going to do a lot in GDP and unemployment. I'm going to compare where we're at right now compared to where we were at in 2007. And you guys are going to see a striking similarity. And the reason I'm going to do that is things can change overnight. So I'm going to be very respectful. I don't want to offend anyone by talking down on these people, but they're huge influencers. And I know if I know that you guys are listening to it because I get so many requests. Travis, will you please respond to Ramsey? Travis, will you please respond to Clear Tax? And I don't like to do that because I offend people that are in our community at Real Estate Mindset. So again, I'm going to be super respectful. Let's start with Dave Ramsey. It's only going to be a couple minutes. Comment below. Let me know what you think. So we're going to start with Ramsey now. Let me kind of set this up for you. So he had someone call in that basically said, Dave, I don't have any consumer debt. I have 60,000 saved. I can buy a house at about 25% of my income. Really good things, right? So I had to ask myself, well, if someone asked me, should you buy, and they have all of the things that I said, no consumer debt, 25% of income, what would I say to them? All right. And that was what I was asking myself when I listened to this. So let's start with Ramsey. And if you guys can, please let me know that the audio is okay. Whoops, let's start right here.
Of any kind of 60 grand for a down payment.
Zero debt of any kind, 60 grand for a down payment, and about 30,000 in retirement accounts and 2 years funded HSA account.
Good for you. Okay. Well done. Well done. Okay. I would buy now, regardless of interest rates. Here's what I don't know 12 to 24 months from now. I don't know what interest rates will be.
Listen to this guy.
I do know house prices will have gone up 7 to 8% a year during that time.
Okay.
House prices are continuing to go up regardless of interest rates, because there continues to be a shortage of housing versus the number of buyers looking. Now, so in other words, the strategy is we can predict that the cost is going to go up, so we might as well get in now. We don't know if rates are going to go down or not, so waiting on them to come down, they might not.
Yeah.
There's no guarantee.
Okay, so again, we're just going to listen to a little bit, and let me kind of summarize, and I'll have this linked in my description if you guys want to go back and listen to the whole video, because there's bits and pieces that both Ramsey and Brian, that I appreciate the perspective. They have some actually really good stuff, but the thing is, someone called Ramsey and he didn't mention anything about wedge. He didn't mention anything about using data to find the deal. He didn't mention anything about cash flow. He didn't mention anything about preparing for a downturn in the economy that we know is coming, okay? He said that we don't know if rates are going to go down, but we know that prices are going to go up. So just buy a house. And honestly, and again, we're going to open the data, but basically, and I'm not going to slam him, but you guys, if you want, comment below. Basically, Dave's thing is this, okay? This is from gathering, listening to his videos. Dave Ramsey believes that prices of homes basically never go down, or if they go down, they go right back up. And therefore, there's really not a lot of risk in purchasing real estate so long as you can afford it. Okay, that's his point. And also his point is that prices are going to stay up because of the lack of supply. Okay, just so we're all clear, that's how I want to summarize that. But now let's go on to Brian. And again, what I'm going to do is I'm going to rebuttal both videos at the same time by looking at where would we get inventory? Where would inventory come from, right? What's the health of the consumer? What's the health of the economy? But again, Dave's point is lack of supply. Prices are just going to go up, okay? My issue is like, you didn't even tell the guy wedge, cash flow data, prepare for the worst. It's just, if you can afford it, send it, because prices only go up. It's a little bit reckless in my opinion, but let's listen to Brian again. So I want to be super respectful here. Here's my man, Brian. And I just want you guys to know, I used to listen to Brian probably about 2 years before I became a YouTuber. So it hurts me to listen to this. But anyways, let me know that the audio is okay.
Critically important, because mortgage rates will play a significant role in determining the value of homes. So especially because of the lock-in effect, which we previously covered very thoroughly. So let's talk about home prices. Home prices right now, they're up 3% year over year. Home prices have not crashed, they're up. People are making all this, so people are making all these predictions. They're making predictions 3 months out, 6 months out, 12 months out. And I seriously cannot believe that people are just overlooking the obvious. I expect home prices to start dipping slightly because of seasonality. I don't understand why people are not accounting for this. Now, I do want to tell you this. Apart from seasonality, I do expect that the economy is going to get worse. And if that happens in that scenario, my expectation is that it's going to affect demand more than supply. So I'll explain to you like this. If the economy gets worse, then less people are going to be looking to buy a home. So there's going to be less demand, right? But the question is, on the supply side, is the recession going to get so bad, will it get so severe that people cannot afford to make their mortgage payments? Basically, I'm talking about a situation like 2008 to 2010, where the recession gets so bad, people can't make their mortgage payments, they get foreclosed on, they have to sell their homes, and it adds to housing inventory. It adds to the supply side of the equation. My expectation is, no, I don't think so. I don't think that it's going to get that bad. If we were on that path, let's just say that we were on that path, I believe that the Federal Reserve would rather print money and inflate out of the situation instead of reliving another 2008 to 2010. But
all right. We got hit by that commercial. Sorry about that. So all right.
Right now, I want to
through this commercial, but so far, y'all, and it's good because they're gonna put copyright strikes against me for playing their videos. But so far, he's bringing up some decent points about what, why he feels what he feels. So I want to give this, I want to give Brian a tremendous amount of respect for at least not being like one of these cheerleaders that's just like, it's just going to go up, you know, supply, demand. So he's talking about some really good things. Like one of them was like the money printing. So that's a valid concern, right? And we'll confront that. Let me go back into the video. Sorry for the abrupt break, you guys. Let's go back in.
I tell you the reality of the situation, and you probably know this, and you might be on the favorable side or you may be on the unfavorable side. Pre-existing homeowners are enjoying their low interest rates, the 2%, 3%, 4% rates. And they're locked in. These people are locked in and they really do not want to sell. It's the lock-in effect. And okay, so these people are locked into low mortgage interest rates, right? Even if the economy gets bad, even if the recession gets more severe, it's going to be difficult for these people to miss their payments. That's because they have lower interest rates and because their loan balances are smaller, because they bought their homes before they ran up 30%. And additionally, we covered this before, it's because these pre-existing homeowners have more equity in their homes. So to me, honestly, right now, I'm more concerned about the new home buyers because they're getting stuck with higher mortgage interest rates. The mortgage payments are, if you calculate the numbers, I'm sure many of you crunched the numbers, the mortgage payments are just ridiculously expensive with these interest rates. Many new home buyers are overextending themselves financially. And this gets me worried because this group of people, the new home buyers, are going to be more vulnerable in an economic downturn. But still, this group of new home buyers represent less than 9% of mortgage holders. But it's growing, slowly growing, but it is growing every single passing month. But long story short, going into the end of the year, going into winter, because of seasonality and economic degradation, I do see home prices drifting lower over the next few months. I think that that's going to be normal, and I'm expecting that. However, ultimately, low housing inventory, it's the same thing. This has been the theme. This has been the story for the past 2 years. Low housing inventory is preventing a housing market crash. And that's not going to change over the next few months because we're still in a chronic housing shortage.
All right, so that's going to do it for his video. So what I want to do is, first of all, I want to acknowledge that I appreciate both. Okay, I'm trying to be really humble, but I appreciate both Dave Ramsey's opinion and I definitely appreciate Brian's. At least, you know, in talking about Brian, at least he has data he's backing it up, and at least his points are really valid points to where, you know, I think a good analyst or someone that, you know, has thick skin rather, is going to ask themselves, why is he saying what he's saying? And what information can I get to counter what he's saying? So really overall, you know, here's I think what, like the bottom line here with Brian. I think his point is all of the price decline that we have seen, which was, you know, a huge, by the way, was from seasonality. And I just want to make clear that seasonality does have a role into things. But we have to also acknowledge that there are other things in play in our housing market other than just seasonality, like obviously quantitative tightening, mortgage-backed securities, right? And obviously the interest rates going up. So as a result of those outside factors of manipulation, call it what you want, you know, it's not just seasonality. And I've made a video and I put up, I think, 5 different algorithms to calculate value. And I showed you what happened back in June of 2022 to about February of 2023 was not just seasonality. Okay. There's things outside of normal seasonality going on. So he's really stuck on seasonality. And really, here's the biggest thing between Brian and I. He doesn't really believe there's going to be job loss. I believe there's going to be job loss. And I believe that any of the 10 million people that just purchased that actually don't have any equity, I believe those people, they're going to have no choice but to sell if they lose their job. And honestly, even if someone has a 3 or 4% interest rate and they're golden handcuffed into their house, it still costs 8% to sell the house. Okay. So it still costs 8%. And if you can't make your bills, you can't make your payments, it doesn't matter what your interest rate is. And that's what happened in 2009, 2008. People stopped making their payments on their mortgage. So, you know, but I do like how he's acknowledging the fact that there's, like, you know, he didn't use a number, but I'll say 7 to 10 million homeowners that are essentially upside down in their house. And honestly, guys, ask yourself, how much inventory do we need? We don't need that much inventory. So again, and he kind of like Dave Ramsey, he is on the no inventory thing. So both him and Dave Ramsey are basically saying that prices of houses are not going to go down because of the lack of inventory. Okay, and that's valid, that's fair. But I like to ask the question, what happens when we do get inventory? Now, overall, I think with Brian, I don't agree. I think it's a little naive, to be honest with you. The lack of caution in the midst of economic recession, in the midst of quantitative tightening, but that's neither here nor there. What I want to do now is we're going to talk about some stuff. Okay. Now, first, let's talk about prices so that we're on the same page with prices. Let me use this actually. Oh, I see Jeff's in the house. He will. You guys, anytime you see him, tell him to do an interview. He's ducking me on the interviews. So let's start with prices first of all. Now, some of the bulls are not going to like this form. Now, this form right here is quarter over quarter median sales price for all homes, not just existing. This includes new homes and it includes existing homes. And what I want to point out is when we add it all together and mix it up, there was no rebound in prices. Do you see this? Again, I understand why it shows it like this. This is showing it like this because this is including data from new home sales, and new homes are plummeting in prices. And honestly, I wish that both Dave Ramsey and Brian would have acknowledged the differences in the market with new construction versus existing, but that's okay. We're the real estate channel. They cover a lot of stuff. But I just wanted to start by showing you quarter over quarter median sales price. It hasn't even rebounded yet. That's how weak the market has been as far as the run up. Now, again, when we remove new home prices, then this is going to have a different trajectory. But nevertheless, here's the entire picture. This is the full picture. This includes all the prices for all the houses. Now, let's talk about inventory. Okay, so we're going to do the inventory now. Now, let's start with talking about inventory, and I'm going to go fast right here. But again, I want to talk about inventory so that if you guys watch or listen to anyone that says, lack of inventory, that's why home prices will be sustained. Let's do a little bit of a counter argument to that, right? So then they have to think like, oh, maybe we should, our opinion should evolve. But let's start with institutional investors. And I want to start with institutional investors because America knows that institutional investors own a whole bunch of houses. Now, starting with the graph to the left, you can see that demand has plummeted. But not only has demand plummeted for institutional investors, many of the top number one institutional investors in America are now selling more than they're buying. That's a double whammy because that also cripples demand for institutional investors. And we are now getting more supply from institutional investors. Invitation Homes is the number one institutional investor. They can't buy properties. They're yielding less than 4% on some of their properties. They can get over 5%, you guys, by investing in treasuries. And also, that's not just Invitation Homes, who sold 600, it's not a lot, but that's just one institutional investor. I'm just starting here, okay? Also, American Homes for Rent. That's also, a top institutional investor. Sold nearly 1,100 homes while adding 780. So institutional investors right now, and this is lagging data, are giving us more inventory than they're taking. And that's a fact. And neither of them acknowledge that. And I get it. Maybe it's because they don't think it's a lot of inventory, and that's fine. Maybe it's not a lot of inventory. So let's move on to our next thing then. Okay. Let's look at the long-term rental market, because the long-term rental market, I'm not talking about short-term rentals. You guys know I'm going to bring that up though. The long-term rental market is very, very close to complete deflation. Okay. So again, long-term rental market is it's disinflation right now, but it's close to deflation right now, which is negative price growth. If rent goes down, long-term investors will sell some of their houses, especially those houses that barely even cash flow. That's 100% fact. We already know that's going to happen. Now, I wanted to bring this up because it's already starting. And I honestly think this year we're going to have a national average decline or deflation in long-term rental. Now, asking rents are down. Did y'all know that? We have like a type of deflation already happening, but this is on the asking rent side. Asking rent is down 1.2% year over year. But look at the trajectory here. All right. And we're talking about the long-term rental market. Look at the trajectory. Okay. So, here's the trajectory. And then again, these are different algorithms to calculate it, blah, 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 blah. But as far as the the national apartment rent is already in deflationary numbers. Do y'all see that? So it's already there. And my point is, all of the other measures of rental growth, look at the trajectory. Okay. If it goes under this line right here, if it goes under that line, that's deflation. Okay. Right now, what we see, these downward trajectory is disinflation. But if it goes under that line, it's going to hurt some people. And it's already under there with apartments, and it's heading that way with SFRs, condos, and townhouses. So I believe as a result of that deflation and already disinflation, we're going to get some inventory from long-term rentals. And that's not only going to give us inventory, remember also that's further crushing demand. Let's keep going. Okay. We're going to now talk about new homes because neither one of them, again, discussed new homes. The new home market is a completely different world than existing homes. Yes, in existing homes, overall, it's super dark. Even though we do have inventory, it's just not being listed. So it is super dark. But when we add it all together, it's a lot clearer that there is a whole bunch. In fact, there's too many, in my opinion, new homes. And we see that clear as day, you guys, with the monthly supply of new homes in the United States. We're sitting at a whopping 7.8 months. And they're not even reporting everything. All right. They're probably, I would imagine there's probably 30%, at least maybe 20, 30% more inventory than what they're actually reporting. Remember, you guys, 6 months is a normal buyer's market, like the buyer's incentives of their buyer's market. So this is well into a buyer's market at 7.8 months. And the thing is, guys, they continue to get permits, more under construction, starting construction. These guys are in a world of mess. And also understand the reason why their stocks are doing well or all this stuff, right? Obviously, yeah, we do need more inventory, but the incentives that they're offering right now are absolutely wicked. Like Lennar's offering 4.25% fixed rate and 15 to 20% price cuts. In my metro, again, you guys, these are all facts. This is no emotion here. This is no guessing. These are things that we've backed up with data and facts. Monthly supply of new homes is astronomical. 7.8 months is humongous. But that's not all, you guys. Okay, look at the median sales price for new homes. Again, neither one of them is talking about the prices. So it's on its way down again. We're basically off of peak. Let's see, what are we off from peak? $70,000. So it's fair to say that new homes never even made a rebound in value. Again, I guess that maybe when they're talking, they're only talking to people that are buying existing homes, because literally everything they're saying, the opposite is happening with new homes. And I would say that the new homes is really important to pay attention to, since 30% of our active inventory roughly is new construction. It's okay. I'm talking about it though, but that's one place we will get more inventory, and we have inventory now, and some of that inventory is hidden. Now, let's talk about this next thing. This is one of my favorite things. I would say that new construction is my favorite, probably my favorite, because I love going out to those sites and showing you guys the shadow inventory and stuff. But my favorite place for new inventory is going to be STRs, or short-term rentals. So what I wanted to do, okay, is I wanted to go to Chicago, all right, because that's Brian at Clear Tax's neighborhood. So it's you know what? Let's look at the STRs in his own metro area, okay? So let's see what I can find. I'm going to start by showing you guys the STRs in Chicago, which is where Clear Tax is located. Okay, so first of all, again, I'm going to Zillow. Zillow's not the best data source. We already know that Zillow is not the best data source, but right now we can see that for rent, you can see right here that for rent, there's 7,057 rentals. And if you guys, again, you want to really hone this in, you can click townhouses, SFRs. Okay, we're just looking at the dwellings right now. So right now there's 7,057 homes for rent in Chicago. Look at how many homes there are for sale. About the same. It's really surprising, actually. So there's 7,117 homes for sale in Chicago. Okay, everyone with me so far? Now let's go to our friend AirDNA. Now, when I search Chicago for AirDNA, remember we start with 10,800 active listings, but that's not a true number of total STRs in the Chicago area. So we got to scroll down and we go entire homes. Now, by multiplying the entire homes by 78%. That's going to give us the total amount of homes, but it's not necessarily SFRs. And that's okay. It could be townhouse, could be condos, but it's a dwelling, right? So again, we take 10,800. Shoot, what do we multiply that by again? 78. Okay, so times 78%, 0.78. Okay, that gives us right now 8,424 short-term rental units in Chicago, which is Brian's backyard. Now, what that would look like when we compare those total amount of units, when we compare it for the units for sale, okay, and this is not going to happen, but if they converted every single one, okay, so we're saying every single one, and I'll show you the bands and what they're doing here in a minute. But if they converted every single one to for sale, that would increase the inventory by double, 118%. And I'm pretty sure that, I mean, Brian's an educated guy from listening to him. I'm pretty sure if both Dave Ramsey and Brian's, one of their huge points is the lack of inventory, I'm pretty sure a double up of inventory is going to make a drastic effect. But when we compare it, even if they don't sell them, if we compare it to the long-term rental market, it would be an increase of 119%. And my question is this. Now that we're seeing Airbnb completely get annihilated right now, what's stopping other metro areas from following the lead, say, of New York, Las Vegas, or even Dallas? Why would they not ban STRs? In fact, actually, they've already regulated them. We have that right here. Okay, so Chicago, again, a guide to Chicago Airbnb laws, has a strict Airbnb regulations. The thing is, guys, the last time that they updated this was 2021. And they've updated this twice. So what I believe, and this is a lot, like, look at all this. There's like massive fines for Chicago. So this is playing out obviously in Chicago. But what I believe is going to happen, I think Chicago is going to re-regulate Airbnb because they've already done it twice before. So again, now that they have case law, they have precedents from other metro areas, I think it's only a matter of time before Chicago and places like Chicago continue the banning. And again, if we go into recession, then we're going to have even lower inventory. There'll be a lower profit margin. But now what I want to do, let's talk about the consumer, okay? Because we're going to get inventory from consumers. We will get inventory from forced selling. And how do I know that? Because we already are. Forced selling is a natural occurrence in the housing market. It happens every single year. The difference is the market good or is the market bad for those sellers? And if we look at the active listings right now, okay, literally we look at them right now, what's going on right now, minimum 30% of active listings of existing homes, 30% forced selling right now. And that's not counting death and divorce. When we just count unaffordability and when we just count returning to work, that accounts for 30% of the active listings. So we're going to continue to get those listings. Come on. I mean, my God, it's happening right now. But that's okay. What I want to do now is let's go even deeper into the health of the consumer by comparing where we're at with things from right now compared to 2007. Take a look at this, guys. This is crazy stuff right here, okay? We're just talking about data, okay? I'm trying not to get emotional. But right now, the unemployment rate is sitting at a historically low, right? Historically low, 3.8%. But what I want to show you guys is right here, August of 2007, right before we went into recession, unemployment rate was all the way down to 4.6%. You guys, that's only a difference of 80 basis points. That's it. It's not even a full percent points difference. We are less than a percentage away from where we're at in unemployment in 2007. Now, if you think that the government is propping up the unemployment numbers, we may even have worse unemployment. But ask yourself a question. Do you believe the government? Do you believe the unemployment numbers? If you don't, it's even worse. But going by just the data, we're off by only 80 basis points. That's not a lot, you guys. That's very, very close. And I also want to point out that unemployment doesn't really get bad until we're already in recession. And that's my additional gripe with Ramsey and Brian. They're celebrating before we've even gone in recession. They're celebrating before the Fed has even flipped. They're still killing us right now. And look at the run up in unemployment during the recession. It hit almost 10%. In fact, it did hit 10% outside of the recession. And unemployment gets worse, obviously, right, when we go into recession. So again, both Ramsey and Brian do not think that we're going to have a significant recession and there will not be significant unemployment. Let's go into the next thing. Okay. GDP. Okay, what's up with GDP? Let me show you guys that. Okay, this is so crazy. This is really going to blow your mind because GDP is lower now. Okay, it's lower now than when right before the recession. Look at this. Do y'all hear what I just said? Right before the great financial collapse, GDP was higher than it is now. How can you explain that? So GDP is worse. It's worse right now than it was in 2007 Q4. Do you see this? Q4 2007, GDP was 2.8. What's it right now, y'all? 2.1. Come on. This is interesting, don't you think? So we're in a worse situation as far as GDP by 40 basis points. These are facts. This is data. This is something that we should think about, right? Because everyone keeps saying to us, strong economy, stronger consumer, no recession, no unemployment. But again, when we compare this, things can happen, snap of the fingers. Let's go and move on. Okay. Let's go to savings rate. Now, right now, savings rate is 3.5. That's historically low. It's really, really low. Now, right before the recession in 2007, let's see, right here, boom. Okay, so it's like went up right before that recession. So December was 3.2. So we have a similar savings rate than we did literally right going into that recession. So about the same. We're actually somehow in a little bit better of a situation by 30 basis points for savings rate, but it is extremely extreme. Wait until I'll show y'all inflation. I'm going to show you guys the worst stuff here in a minute, but we're just talking about the consumer. But that's the savings rate. Let's look at now the wages. Okay. So let me see. How did I want to show you this? Okay. So here's the wage growth. Okay. So here's wage growth. And really what I wanted to show you is, wage growth is very similar to where it was in 2007. But what's not similar is like the run up, right? So like before we went into recession, wage growth was for years 3 to 4%. Now, after that, look at how long it took to get to 3%, not even 4%. So the wage growth isn't the same to get into where we're at right now, except if you believe this, which I don't. I believe this is not complete nonsense right here, but it is what it is. But as far as wage growth, you can look at it a few different ways, but overall, the wage growth is way worse. It is way worse because you can see how elevated it is here on the left. It's way higher. So again, just going into a little bit about what's going on with consumers right now, because we will get inventory from consumers in distress. Let's keep moving. Okay, on top of all of that I just showed you, right now, 60% minimum, 60, and this is really sad actually. I mean, if you really think about it, and if you're one of these people, my heart goes out to you, and I'm going to tell you right now, you need to change something if you can. I know things are hard, but if you can, like right now is really important to save money before we go into like really super dark times. But right now, 60% of people are living paycheck to paycheck. Is that not a crisis, you guys? To me, that's a huge, huge crisis. Okay, let's keep going. This is going to blow your mind. Now let's talk about what's worse. Okay, now let's talk about the economy. So I showed you guys the consumer. The consumer's is not in really good shape. In fact, it's comparable to 2007. In my opinion, the consumer is in worse shape now than 2007, except for the people that purchased before 2022, low rate, high equity. Okay, but let's look at inflation. Inflation is not even comparable, you guys. Inflation leading up into 2007. Okay, look at this. Here's the inflationary numbers right here. So from 2006 to 2007, inflation was 2 to 4%. All right. So that's what we had. That was let's just call it the bubble, right? That was part of the bubble, 2 to 4% inflation. When we go up here, when we look at 2022 to 2023, inflation was 3 to 9%. Inflation right now is way, way, way worse. Not even comparable. Inflation is not even comparable to where we were at in 2006, 2007, and into 2008, and pretty much for a very long time. So inflation is way worse right now, which probably means we're going to have more pain. Now, let's move on to the next thing. Okay. Take a look here. Unaffordability. This is the national payment to income ratio. Let me move my picture. This is the national payment to income ratio. Right now, we're sitting at 38.3%, which means that gross median household income, 38% of that money goes to only principal and interest, not even taxes, not even insurance, not even a mortgage insurance, not even HOA. This isn't even real, and it's unprecedentedly high right now. So I just wanted to also mention that even though many consumers are weaker than 2007, what we know is the unaffordability is way worse. We're sitting at 38.3. Again, back during the great financial collapse, it peaked at, looks like, under 35%. Okay, so the payment to income ratio, it's way worse. I mean, that's a fact. All right, let me go to the next thing here, which is, where's my next thing? Right here. PE ratio. PE ratio to me, now this one's a huge one to me because this has to do with price. And price has pretty much been what we've been talking about and what I've been talking about the whole time. The PE ratio is basically the price of the houses, in going into how much income people make. Now, in 1980, when we had a huge inflationary crisis, the PE ratio only got to 4.69. That's it. So the consumer, you could see in the 1980s, way better off consumers in the 1980s, and that actually sustained. Now, look at the housing bubble. It only peaked at 7.03% and then crashed hard. In 2022, we were at 7.76%. These are the lack of fundamentals. The lack of fundamentals makes it to where it's not sustainable, and I don't know why that's so hard to look at. These are things outside of seasonality, you guys. These are all things outside of seasonality. Now, let's go on to the next thing. Here's my gripe again, the equity run-up, all right? That's the other thing. The foundation is weak. The foundation's built on a house of cards. Now, here's the just cue. This is quarter to quarter for median sales price. This is all homes. This is not just new homes, not just existing homes. This is the entire housing market. And what I wanted to point out is how small the last bubble is in comparison. If we go right over here to 2002 up into about 2009, look at that bubble right there. Okay, that was the last bubble. So therefore, any of the people, even if they don't agree to me, they have to acknowledge this bubble right here. And I'm not saying bubble like we don't have to say bubble like it has to pop. Just acknowledge that there's a freaking bubble here, and that equity run-up, it broke every freaking fundamental and sustainability principle that we have in existence of America. It broke it. How are they not talking about it? Neither Ramsey or Brian talk about that. So it's fair to say it's a little bit risky. And look at, again, the quarter over quarter does not even show a price rebound, you guys. They're taking a victory lap pretty fast here. Pretty fast. Now let's look at this, okay? Here's what's going on right now. This is one way to stay ahead of all of the lagging data that both of them use. Rolling average median sales price. Okay, again, I think this data is tainted. There's about 600 MLSs. Obviously, Redfin can go behind the scenes and push buttons and pull levers to manipulate this. But now we can finally see, like I've been projecting all year. And I've been taking a rash of crap over this. But I said, basically, this is where we're going to start going down. Almost exactly where we started going down. I thought the trajectory downward would be steeper, but it's steepening. Okay, it's steepening. This is median sales price. And honestly, if it ends right here, if it ends right down here, which I believe it is, in fact, I have a bet with some of my viewers. It's a gentleman's bet. It's not a real bet. If that happens, that means that people that purchased middle of 2021 on, from an equity standpoint, are all stuck. That means that there was no price growth because there is seasonality. You have to let it play out. But anyways, Johnny, you ain't going to win that bet, Johnny. You ain't going to win the bet, Johnny. I looked at, and I'm going to do a new report for you guys. The report that I'm about to go over for Redfin, and I'm not going to do it on this video. Everything is pointing to exactly what I'm saying. I don't know if I'm going to win the bet. I'm worried about the inventory bet. I think I'm going to hit the median sales price decline, but I'm a little bit worried. I'm a little bit worried about winning my dollar from the inventory standpoint. Although I do believe it's actually, I still have a good possibility of that, especially if we start seeing a lot of those STR owners start to list their properties for sale. We've already seen that inventory can go up and fall in winter. We've already seen that. We saw that last year. And I think we're going to see it again this year. I think we see trends that we've never seen before as a result of not seasonality, not just seasonality, but as a result of the quantitative tightening that both of them are ignoring. But one thing I will say before I end this, one of the things that Brian, that I respect about his opinion is, one of the backstops to price decline, not just the inventory, is the bailing out. I mean, he's just said it. He's like, I think that the government, instead of going into like a 2008 type of crisis, is just going to bail out people. Now, I believe that's a valid point. I believe that if they bail out if they do more money printing and they do more bailing out, I think that's going to be really bad. And I don't know exactly what's going to happen. I think it depends on the type of bailing out, and it depends on the type of black swan that happens. So it is important that they stop printing money, right? And that's technically, isn't that our money? Isn't that our money? So good points there. Let me know if you guys agree with my conclusion. I'm going to move on to the next part of this video, but that was just really long-winded. I really wanted to just give you guys my opinions there. I wanted to do it super respectful, let you guys know I'm not afraid to talk about nothing, especially if it's respectful. My conclusions are the same after listening to both of them. In fact, not only are my conclusions the same, it actually is super depressing because both of those guys have the ability to move, what, a couple million people? So I think people should be moved in a cautious way, not in an optimistic way when we have this type of stuff going on. So I'm going to pull up, just got a super chat. Let me just see this super chat real quick, and then we're going to go into our next video about the government shutdown. I had one question at the beginning of 2022. What would you do if your money had no value? That is the effect of inflation. It's the greatest tax. So if, I'm not sure. So like, what would you do if your money had no value in the beginning of 2022? Honestly, man, I would try to probably buy a house in 2020, to be honest with you. In fact, I put in multiple offers in 2021 and in 2022. And honestly, I was still helping people in 2020. It wasn't until 2021 hit, Denise, where I was like, oh my God, like this is going to be bad. And then the fact that I noticed that towards the middle to end of 2021, and the fact that it got like way worse into the beginning of 2022 just made me like, okay, this is even worse. And then it started getting better. And then it started getting worse this year. But inflation is bad. So some of the things that I'm doing, Denise, to offset the inflation is I'm taking my liquidity and I'm putting it in the T-bills. So that gives me a couple, $200-$300 back a month to help fight the inflation. So as long as like at the bare minimum, people are putting their liquidity in at least in treasuries, I think that's not a bad thing. So I appreciate you guys. Let me know again. I want you guys to comment below. Let me know about your conclusions about Dave Ramsey, about Brian with Clear Tax. And please let me know if you thought I was respectful. I really wanted to go out of my way to be really humble and respectful. And trust me, you guys, I could have been way more brutal. And I wanted to, a little bit of me wanted to actually. We're going to go into our next video about the government shutdown. If you guys can, throw some comments on the screen and I'll get to them. But let's start with this right now.
Country is careening toward a shutdown of the federal government.
Whoops.
Less than 72 hours from now, with Congress so far unable to make a deal to avert it. The deadline, Sunday morning at 12:01 Eastern Time. That's when discretionary spending by the government, absent a spending deal, will stop. That includes no paychecks for federal workers, no government benefit payments, including some for veterans, and the closure of federal parks and monuments, and much more. Yet despite all that, the shutdown threat was not the only matter consuming Congress today. Republicans turning some of their focus to an impeachment inquiry into President Biden. Despite a key witness who testified today, the case against the president so far isn't there. Ryan Noble starts us off tonight.
Tonight, a potential government shutdown, once measured in days, now down to hours. And despite the time crunch, lawmakers are moving slow.
Congress has only one option to avoid a shutdown: bipartisanship.
The Senate advancing their version of a short-term spending bill, one the House Speaker has said won't pass on his side of the Capitol.
At the end of the day, do we get this done? The answer is yes.
Staff Sergeant Antonio Hayes has a daughter and is scheduled to deploy this week. He's not sure if he'll still be getting paid.
Losing a paycheck would definitely be rough for me. That's something that I've never thought about it because I've been in the military this long for stability.
And while many are planning for the worst, House Republicans kicked off their first impeachment inquiry hearing. Democrats posting a shutdown clock and arguing Republicans have yet to provide evidence President Biden directly benefited from his son's lucrative foreign business dealings.
If the Republicans had a smoking gun or even a dripping water pistol, they would be presenting it today, but they've got nothing on Joe Biden.
Republicans countering they've collected evidence that is worth further exploring.
Whether it was lunches, phone calls, White House meetings, or official foreign trips, Hunter Biden cashed in by arranging access to Joe Biden.
A GOP witness supporting an inquiry, but Democrats asking if he would vote to impeach now.
You would vote no, correct?
On this evidence, certainly.
Before today's hearing, we pressed a top Republican about a WhatsApp message they say Hunter sent while his father was not in office, describing the Biden brand as his family's only asset.
How does that demonstrate that there's some sort of political influence being put over him if at that time he is not he's not an elected official?
Sorry.
I'm definitely not going to pinpoint one item. I think we've outlined.
You presented it. It was your first thing that you brought up.
So apparently you don't agree with it. So
It's not that I don't agree with it. I'm asking you to explain it.
I'll take the next question. Yes.
And Ryan, federal
All right, we're
agencies
done with
are
that.
already
I didn't
preparing
mean
for
to
a
get
potential.
too political there with you guys. For sure, I don't ever want to talk about politics on this channel. I learned that the hard way. I'm sorry about that. But that's a government shutdown. More than I'm just so disappointed in our government shutdown. So disappointed in that. They still get paid. It always costs the consumer. It always costs us. So talking about, the armed forces, and it's just an ugly thing. And it is possible that if the government does shut down, it is possible that rates do go down. I don't think that it'll go down majorly, but the longer that the government is shut down, if they're even shut down, yes, that could drop interest rates. Now I'm going to listen to our last video, and thank you guys so much for staying with me. And I'm going to get to some of the comments that I threw up on the screen here at the end of this video. But this video is going to go into the commercial real estate meltdown, which is an entirely separate black swan that I didn't even talk about. So there's a lot of stuff I left out from the reaction to those videos, but it is what it is. Wanted to keep it short and sweet as best as possible. Here's our last video.
Performing S&P sectors this year as concerns mount over the health of commercial real estate. For more on what lies ahead in this space, let's get out to our Morgan Brennan, live at Delivering Alpha with Blackstone's global co-head of real estate, Kathleen McCarthy. Morgan, over to you.
Frank, thanks. And Kathleen, we just got off stage. It's great to have you here. I'm going to start with the same question that we just started with on the panel, and that is there's been a lot of hand-wringing about the state of commercial real estate. Is it warranted?
Well, the state of commercial real estate is not one thing. Different sectors are traveling at different speeds, and our job as investors is to put our clients into the sectors that have the best performance. So if you think about the best performing sector, is a high conviction for us, data centers. What we're seeing is an explosion of demand because this is built on more content creation, more commerce happening over the internet, and then of course now all of the demands for AI. We bought a company called QTS a couple of years ago. In just the last year alone, we've done more leasing of space to our tenants than in the company's first 15 years combined. And we have line of sight to the company being 6 times bigger than we bought it. It was a $10 billion take private. And that is just because more of our life, more of the world is happening over the internet, the digitalization driving demand for that asset class. On the other end of the spectrum, of course, is traditional office, well-worn subject, but obsolescence of those buildings, and now, of course, the weight of higher capital costs is having an impact. But across the spectrum, you have different things traveling at different speeds.
Yeah, and Blackstone is the largest real estate investor, not only in the U.S., but in the world. So you certainly have your finger on the pulse of some of these different subsectors. You exited office before we even had the pandemic. Why did you do that? And when you start talking about secular growth stories and things like data center, why is that compelling now, even in a higher rate environment?
Well, we invest thematically, and we try to look at the world and what's happening and say, okay, which are the asset classes that are benefiting from trends and changes in how people are working and living and shopping and traveling? And on the flip side, we try to pivot away from more challenged asset classes. And when you think about traditional U.S. office buildings, that story is also, about who we are. We look very carefully at all of our data. We have $600 billion of real estate, a heritage of studying what's happening in our portfolio to try to inform our next decisions. And what we saw happening was lower cash flow growth, high CapEx costs, and really a share shift to the newest, best office buildings. And so we felt like we wanted to be in asset classes with strong cash flow growth and short duration leases because we wanted to be positioned in the right sectors and with the ability to grow cash flows in what might be a higher rate environment. And we're living that now. You can think about real estate like any other asset class. If your multiples are not expanding, or in our world, if our cap rates are not coming down, we need cash flow growth in order to drive value for our customers. And 50% of our portfolio today are in those best weather sectors, logistics, data centers, student housing, where we see strong cash flow growth. And that is helping us deliver continued great performance despite higher rates.
Okay, so you raised a record $30 billion for your latest real estate fund earlier this year. Are you already deploying that capital, or are you waiting for values to become more attractive here?
Well, there's never an all clear signal. And we've been investing in real estate for 30 years. We know that we always want to be looking for opportunities, but the $30 billion we raised last year is something where we're going to be patient and make sure we're finding the best opportunities. This year, a lot of our activity has really been focused on Europe, where we've seen, I'd say, the most negative sentiment around real estate, around the market environment, translating into opportunities for us to take private companies, to buy assets from sellers looking to delever, buy assets from sellers who are forced to liquidate. And we're doing that, though, of course, still in our highest conviction themes. 50% of our activity this year to date has been in logistics, because we still see continued growth, high leasing spreads, very low frictional levels of vacancy. And we see those assets as interesting in our ability to create fundamental value in what is a dislocated environment.
Okay, Kathleen McCarthy, Blackstone Global co-head of real estate. Thanks for joining me here at Delivering Alpha. Frank, I'll send it back over to you.
All righty, so that's just a little bit from what one of the biggest institutional investors in the world is going to do. And pay attention to what they said. If you want to know what all the millionaires and the big powers, they just said, when it comes to purchasing real estate, be patient and find opportunities, which is exactly what we've been saying the whole time. So having said that, I want to go back to what Dave Ramsey was saying to that caller, okay? Because it was a call in a situation to where I actually had to think, like, what would I recommend if someone were to call me, and a lot of people call and email me. And if you're emailing Real Estate Mindset, again, understand it's a correspondent. My email's correspondent, where we could talk as friends, right? It's not a business relationship. If it's a business relationship, other stuff has to be done. But if I had someone call me and say, Travis, just like they called Dave Ramsey, they said, I'm out of consumer debt. I have $60,000 saved. 25% of my income can go towards paying the mortgage on a 15-year loan. I would say, okay, you're in a great position. Are you sure you're good at, you sure you have the job security? If they say yes, okay. Are you prepared for an economic downturn? If they say yes, okay, let's move on. But none of those things happen. And then I would also mention to someone that would say that to me, okay, fine, you're in a good position, but when you go out to buy, make sure you find a property with wedge. Because if you have to sell, and remember, people don't plan for unemployment. People don't plan for unemployment. So I would say if you have to sell, you want to make sure that you have wedge, because if you have wedge, you can take a hit. So if prices go down like 10, 15% and you have wedge, you can take that hit, right? So I would say wedge, and I would also say cash flow. And I would definitely caution them, like, hey, and I have done that. And then with one person that I did help, and I cautioned them the whole time, they have to move 8 months later and they're upside down their house, literally. So I feel so bad about that. But again, you just can't prepare for certain things in life. And that's just the reality. So again, if that caller called me, I'd say, you know what? You're better off. You sound like a strong consumer, but understand buying right now is one of the, historically, with the data, one of the worst possible times to buy. And then also I want you to think about the fact that the dust is still in the air. There's still quantitative tightening. The story's not done being told. Now, I believe when the story is done being told, values are going to be declining. They believe that when the story's done being told, value is not going to decline. But the thing is the story's not done being told. So I would caution them. I would definitely stay in caution in the conversation versus kind of a reckless optimism or foolish optimism. So anyways, guys, that's kind of my final conclusion. I'm so sorry for rambling. I'm so tired right now. I'm going to pull up some comments. I see Trey, thank you for this, brother. I got that in the morning. Welcome as well. Now, I just want to throw these up. It's going to be really fast, you guys. In my opinion, if I'm a buyer in San Diego or anywhere that has no inventory, I'll buy now as long as I can comfortably afford it and I have job stability. Just look at a house that can cash flow. That's just me. So literally, and this is why I like House Hacker. House Hacker and I, we agree with a lot of things. We don't agree with everything, but this man right here, he's boots on the ground. He's boots on the ground. He's giving us intel in San Diego, and he's a part of our community. And I recognize how blessed we are to have people like that. He found a great deal in San Diego when no one else can. Pretty much. Props to you, House Hacker. The only thing that I would add to the cash flow is the wedge, right? I would add that wedge, and I would also caution, like, hey, even if you think you have job stability, can you afford the house if one of you loses a job? Right? Like if your spouse loses a job, can you still afford to live there? But at least what House Hacker, like, look at the fundamentals he has there. You know, like, okay, prepare, you know, for as long as you have job stability, blah, 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 you're cash flowing. At least there's some value in what he's saying. And thank you for that, House Hacker. I would just add again those two things, like, can you afford the house with half the income? And obviously, you know, the other thing that I mentioned, here's a comment from Jason. I'll make an even bigger bet. Housing will double. Yes, double by the time we get to the top. Then we will see a double. So I don't know the time frame, but I just want to put this up here like, hey, okay, appreciate the comments. It's okay. Not all the people are trolls, right? There's some people that actually believe these things. Man, you just think about if prices doubled, how like bad would the PE ratio be? Like so like I'm assuming what he's saying is like prices double, but wages don't double, right? That's what you're saying, right? Like prices double, but wages don't double, right? So like how could people afford, like they can't afford right now, like only 20% of America can even afford the average house. So if that doubled, then I just don't see how that would be possible. But thank you for your comment. RNT is in the house. The powers that be want a recession without a crash in asset prices. They may just get what they wish for. He's right. There's nothing that's a certainty. There's probabilities of things. And honestly, man, when we look at all this stuff, there's no way that I think asset prices are not going to crash. But yeah, the powers that be don't want their assets to crash in price. Or do they, so they can buy more assets? Think about RNT. Maybe they really do want assets to crash because, you know, everyone's saying we're going to be a nation of renters. So wouldn't the elites love for people to get crushed right now and their buying demand to get destroyed? Wouldn't they love asset prices to go down so they can buy them? Think about it. I don't know. Maybe not, right? Here's another great comment. Obviously, people could do irrational things, but it would be stupid to print more money. And I think Powell does know that, Ruben. I mean, I think anyone that's educated in economics knows that money printing can be a really bad thing. And it was a really bad thing because a lot of it was fraud. A lot of the money printing did not go to where it was supposed to go. It went into the hands of fraudsters. Dave, nice to see you, man. Love you, Dave. Really want to get him on here to do an interview. Dave just purchased a house as well. New construction. Love you, brother. Huge appreciation for Dave. Unless there's a catalyst like massive layoff, correct, that will force people to sell, there probably won't with the low interest rates. I think property tax and homeowners insurance is going to be the catalyst. So Dave is basically saying, like, and there's a lot of validity to this. Yes, and that's what I was saying, dude, like the unemployment is going to, in my opinion, like if we were to just point at a couple things, like we're looking at the inventory for STRs, new construction, but layoffs. I think the layoffs are going to be a huge determining factor on how much prices of houses go down. And again, we're still in the quantitative tightening. We've never left that. Unemployment is finally, after a year and a half, is finally going up. But definitely the property taxes and homeowners insurance is an issue, Dave. I just think the bigger issue is the prices. And then topped with the interest rates. I think that's a huge issue, brother. Okay, yeah. So I answer this. Thank you for that support. Really appreciate you. I think it depends on the bank, right? If it's a regional banks are a little bit more at risk than the big depository institutions because a lot of those regional banks have the toxic commercial debt and stuff on their balance sheet, and then also perhaps unrealized losses from the lower yielding long-term treasuries. So I just don't see why anyone would want to like not do T-bills. So here's the next question. Where do you get T-bills? So all I did, because I didn't know how to buy T-bills as well, all I did is I just typed in how to buy T-bills on YouTube, and I watched, I think it was Marco's video, the guy that does the whiteboard in the background. And honestly, guys, it took me 15 minutes to learn how to buy T-bills. Now, I buy them personally. I'm not giving financial advice, from Treasury Direct. And I'll be honest with you right now, when you go to Treasury Direct, it's like the 1990s and 1980s website. And we didn't even have websites back then. Like that's how unofficial Treasury Direct looked like. But I got to assure you guys, that's where I buy it. But it definitely does not look official. It looks like a crappy website. Scott, thank you for commenting. Nikki B, I think the administration will subvert Congress and try to claim a national emergency to try to buy votes. Like a war with Ukraine. I'm sorry, like a war with Russia. I don't know, man. I mean, I don't even want to say these things. I don't want to get political. But I want to know what the politicians are saying about the housing market. Here's a comment from Eric. What are your thoughts on Tampa, Florida market and how new construction homes will affect that market? I think, Eric, that's going to depend on how much new construction is going on in Tampa. Now, I will say Tampa has had a massive, massive run up in equity. And I think as a result of the massive run up in equity, I really feel like it is going to fall, man. I mean, I don't know that. You need to tell me. You need to be watching your metro area. But some of the things that I would do, though, if I'm in the area, is I would look for the new construction, and I would look at how many STRs there are by going to AirDNA. And then I would research what Tampa is doing to ban Airbnb. But you guys, if we really think about Florida and whole, the natives and the local in Florida probably took a hit worse than anyone else. I mean, literally, the home prices went up 70, 80% in many areas in Florida. That rug pulls the locals. Okay. Here's another comment. I'm not 100% sure what this means, but you need to stop being fixated on prices. The measure of prices, the only goes down. I'm not sure. Prices don't only go down, obviously, but the thing is, Peter, I'm 100% fixated on prices because to me, that's the most important thing. To me, the price is more important than the interest rate and the payment. And honestly, it's even more important than my love and emotional attachment to the house. I think prices is the number one. And without getting the right price, we can't even find wedge. So in order to find wedge, we actually have to be fixated on prices. Thank you for your comment. A shutdown will help rates go down drastically. I don't think so, Alpha. I think that it does have a potential to drop rates, which would be so frustrating if rates go down. I don't know that it would be drastic because we have other factors at place here that's driving that up. But it's definitely certainly possible and actually probable that rates will go down somewhat, depending on how long that lasts. Florida beach bum, love you, man. Wish I was like you. Wish I was a beach bum. Remember why Ramsey will keep telling all to buy, even if he knows values are falling off a cliff. He will never risk losing the millions he receives from his endorsements. He said it, not me. Again, I wanted to be super respectful, but I mean, I'm pretty sure everyone knows that he runs a lead generating business, right? Last thing from Luke, when will we stop talking and start doing? Luke, I hope you start listening right now, because if you're listening, we should, and this is no knock to you, thank you for your comment, we should be doing something right now. Like, I'm literally talking about doing stuff right now. What should we be doing? I think this is a good place for us to end. What should we be doing right now? It depends on why we are on the sideline. If we're forced on the sideline because of lack of credit, lack of affordability, well, then you got to take baby steps. You got to rearrange your credit, cut your expenditures down, and things of that nature. If you're on the sidelines because you're choosing to, like I'm choosing to, what we should be doing is enhancing our comprehension of our local housing market. We need to be able to, as consumers, understand how to access data. Comp data, sold property data. We need to be able to access to do a market analysis. One of the only ways sometimes we could do that is by working with a realtor that has access to that. Okay. And it is what it is, or become a realtor yourself. But the thing is, guys, think about what Luke is saying. Most people in America are just talking. Most people are not doing. That's an incredibly powerful comment. Because again, I really believe this in all my heart, all my soul. I believe the people on YouTube that are enhancing their lives, that are growing, are not like normal people in society. Normal people in society are just going to complain and whine and use their emotion. And we see it all the time in the comments and keep their head in the sand. But that's not us. That's not us. In fact, it's so not us that I plan on having that home buying course ready for you guys before the end of October. And I'm going to be offering it for free. And I'm not only going to offer it for free, I'm going to try to make one of the best home buying courses in America. I'm going to take 22 years of my pain and suffering and experience, and I'm giving it to consumers. I'm going to do it. Now, maybe I'll charge for courses for investors. Who cares about the investors? Whatever. But to the consumers and the people that just want a house, I'm going to give back to y'all. And I'm going to be the guy that that walked the walk. And I'm going to be the guy that that walked away from money to help you. That's what legacy is. And I believe, you guys, if I do that, all of the pain and suffering that I went through my entire life, 2008, and all of that horrible stuff I went to, I think it will be for a reason. But I got to get that value to you. And I want to see people grow and change and succeed. So that's what I'll be doing. Other than that, guys, I think that I'm going to get out of here. We've been on for an hour and 8 minutes. I'm going to be releasing a video today. I don't think I could do any more videos though today. I don't think I'm going to do a video on Redfin. I'm just too exhausted. I think I'm going to go play with my children right now and make forts. But I just wanted to say happy Friday. And if you are out there investing in real estate, you guys already know I wish you luck. And I hope you win.